Hi everyone, hope you're all doing well, and today I'm doing a bit of a follow-up video from my Friday video which I posted just talking about not even the stock market in general. I did a video talking about Hims and Hers stock and just a bit of an update on that, and kind of showing that even though the stock price is going down, the market cap is going down, that company was making so much progress. You know, the valuation was the lowest it's ever been, and since you go back to say the valuation that it had maybe a year and a half ago, and you look at the progress the company has made and the deals it's made, you're looking at all that and go, but now it's at its lowest valuation ever. This company is doing absolutely amazing. Keep focusing on what the company's doing for the long-term vision, not what the price is doing in the short-term time frame. And if anything, if the market keeps giving you a cheaper valuation, the cheapest valuation it's ever been at, that's probably a good time to be buying that stock. And that's basically a little bit of an update into Hims and Hers after a new partnership they announced only recently on Friday. Now, what took me by surprise was the reaction, and I think maybe the reaction was because we have had, obviously growth stocks and small market caps have had a pretty poor 2021, and then that's continued into 2022. But the other thing is now you have the stock market for the whole indexes is starting to fall off a cliff. You've got the Nasdaq in correction, you have the S&P very close to a correction, and now what we're starting to see is the people that just said, oh, it's only small caps and growth stocks, there's no problem with the stock market. Now the whole stock market is entering a bit of a slump, and because we are now finally hitting a proper stock market slump that we've not really seen since March 2020, we've not really had a big massive dip in the stock market. But what you have now is definitely small market caps and the growth stocks have been absolutely battered. Some of them have wiped off so much percentage in gains, and let's not forget a lot of those growth stocks as well. People are talking quite negatively about them at the moment, but you also have to remember, if you were owning some of them growth stocks over the last 2 years, you haven't done too bad. That's one thing that I always see. I see people always quoting a lot of these growth stocks that are down from like the 52-week highs, but realistically, how many people bought them growth stocks at 52-week highs? Not too many. So there's always that little thing that is being used at the moment, but that's also another thing that you got to take into consideration. But going back to the point is that growth stocks as well, market caps, they're down at 52-week close, they've been hit hard, but you have now the whole kind of indexes, they're starting to drop off their 52-week highs as well. And just in general now, that's just caused so much negativity into the stock market, and because of that negativity in the stock market, what you've seen is, because obviously YouTube has a lot of retail investors in, is the amount of negativity that's in there with the retail investors now. There's a lot of negativity about, oh, I don't like this stock anymore, this is a terrible stock, I want to sell all these stocks. And when you have, which I've still not covered at the moment, but probably worth a main video, and you have YouTube, one of the biggest stock market YouTuber, Meet Kevin, come out and saying, oh, now we've had a bit of a drop, I'm going to sell everything, I'm going to try time the market. It kind of sums up, where we're at with the stock market. You've got a lot of people that are quite new to stocks panicking about what to do at the moment, and now that we've got a little bit of a drop, you're starting to see who actually is, everyone claims to be a long-term investor, especially when the stocks are going up and are buying at all-time highs, but now you're getting stocks on sale and they're at cheaper valuations and they're going down. You're actually starting to see people claim that were long-term investors selling them out at one of the lowest valuations they've ever been at. And you're like, what are you doing? You're not going to be a successful stock picker if you are selling stocks at 52 close. You are not going to do well. The whole point of the game is to buy low and sell high. Even if you do buy quite high, the benefit you have is that you can average down. There's a few stocks that I bought, and I looked at them and thought, yeah, it's a decent valuation, I'm happy to buy because I'm not going to try time the market. But what has happened clearly is that some of these stocks have now gone to the lowest valuations they've ever been at. And in my opinion, did I ever think they were going to go to the lowest valuation they'll ever been at? No. So that's something from my point of view, that obviously there's a few stocks that I have and own now that you look a bit of an idiot going, you're down 30% on that stock. But realistically, do you realise that's going to happen? Do you realise they're going to go down to lowest valuations ever? No. But what can you do? You can average down. And the thing is, as a long-term investor, you have time on your side. As long as you have a company that's going to do well in the next few years, then the great thing is that share price probably will come back. As long as it carries on growing, if you've got the game plan, you've got the time frame, as long as you can hold it, you'll do quite well. You'll still break even, and in fact, you're probably going to make money on that investment as long as you picked a good stock. One stock that came onto the stock market in 2012 was a company called Facebook. It IPO'd around $30. Next thing you know, in 6 months, the IPO fell off a cliff. The stock went down to $10. Everybody was saying it was such a terrible company. And if you bought at $30, yeah, you might have bought at a bit of a high valuation, but then you look 10 years later, what's Facebook valued at now? Even if you bought at a really high valuation at the time and it lost half its value, as long as it was a company that carried on growing, you do quite well from them sort of investments. And that's the big thing, is that you actually start to see who's actually got conviction in the stock, who's got a game plan with that stock. And this is a big thing when the stock market goes down, is that you actually see who's quite emotional investors and who actually can basically make the most money are in these sort of situations right now. And on that Friday video, I saw so much negativity in the stock market and people now wanting to sell stocks at 52-week close, or stop buying stocks at 52-week close. I've seen a few people that make videos on the YouTube scene go, oh, you know what, I'm not going to buy any more stocks now, I'm just going to wait it out. It's like, hold on, you're waiting it out. You won't, when stocks were going up at 52-week highs or we were going up, you weren't waiting out on stocks right now. Like, so why are we going cheaper and cheaper and cheaper? And now you're going, I'm not going to buy anymore. You know, you might be a little bit short on cash, but as long as you still got some cash going in, you still want to kind of take advantage of them dips. You know, there's no definition of when the stock market's going to bottom out. You know, people, you can't time the stock market. We might bottom out in the next week and then you're looking an absolute idiot because you weren't buying. Same time, it might bottom out in 6 months' time and then you might look a little bit of a genius by holding off, but you can't time the market. So as long as you see stocks you're happy with to hold for the long term and you've got conviction on, you shouldn't worry about that too much really. And on that video I saw 2 points of negativity. I saw that negativity of people not wanting to be involved in the stock market, not wanting to buy anymore, leaving the stock market. And even some good comments, I saw some negative comments towards me in the video. And in that video was, you know, saying about the stocks that are down in the short term. You know, that's part of the game. There's going to be times where you go down on stocks in the short term. You know, there's no way I could predict that in a few of my investments, you know, Disney, DraftKings, whatever stock you want to pick on, there's not anything that I could predict that them stocks would have dropped how they are doing right now. There's no way that I would have known that some stocks were going to drop down to the lowest valuation they've ever been. That's something you've also got to be careful of. And the thing is as well, what does seem to happen quite a bit with the YouTube scene at the moment is that you're always judged off the short term. You know, only a few months ago, you know, when stocks were going up and everything was going well, you didn't hear many complaints there because everyone was looking, oh, stocks are going up, your stocks are going up, oh, everything's happy. You know, absolutely amazing. Now we've had a bit of a bumpy period. Everyone's like looking at it going, oh, this stock's down, that stock's down. What's, you know, you don't know what you're doing there. That's not working out, and you're getting judged off the short term. But once again, as soon as the tide turns and stocks start going up again, like, oh, absolutely amazing. It's weird how it happens on YouTube. Like, it's really judged off short-term price movements rather than long-term price movements. You know, if we go back to, if we actually start judging investments over long-term, let's look at Greg's over last year. We just sold 100% profit out. Tesla sold out for 100% profit. GWPH sold out for 100% profit. GNOG sold out for 50% profit. Glue sold out for 30% profit. Plenty of other companies as well. You know, it's so easy to kind of judge it off the short term rather than judging it over a long term. And that's why you want to be judging your investments off, not over short term. And what seems in particular is YouTube is very much received over a short term period, when really if you're a long term investor, you should be judging it over the long term period. And if you judge it over the long term period, it's been pretty decent. And that's the thing, is you see so many people negative about the stock market now, but it's only been, you know, negative for the last 3 months. If we start judging the stock market over the last, you know, 1 year, 6 months, it's been pretty good going. And now that we have a cycle where you can buy things again for cheap, you know, you would have learnt from March 2020, the best thing to buy is when we were in the dip. You would have made more money from them. And also, you know, there's always going to be people that are emotional right now. You know, there's people that are, you know, invested into companies that are going down and they're very emotional by it. Obviously, there's also people that don't want you to succeed. You know, when I was buying Greg's before, you know, people were like, oh, Greg's is a terrible company and everything like that. People generally don't want you to do well in the stock market. It's generally people, it's really weird. People do come onto the internet and watch stuff or follow people and then not want them to do well or enjoy giving negative things out on the internet. It is weird. And also the thing is, at the moment, people need someone to blame. People need someone to blame of like, oh, that stock's going down, it's your fault, you know. And sometimes you see that on like Yahoo Finance, like, oh, this stock is falling down, it's lost half its value, blame the CEO, the CEO's not doing a good job. That's what they do. And that's generally like some of the negative that I've seen directed more towards me over the last kind of, on that video. But when we go into like the negativity in general, is that we've also had 1 year or 1 year, 6 months of a really good run in the stock market, and now we're having a bit of a dip. People are adjusting to that. People have gotten used to a stock market that was just going up all the time, and now that we're having a stock market that's going down, people are getting used to that. And for quite a few people, there's quite a few new people in the stock market. This is the first time going through a dip. You know, a lot of people that went through the March 2020 dip, a lot of the people didn't go through that. You know, obviously some of you guys here will have gone through that, I went through that, but quite a few people that got into the stock market would have only really got through like the end of the March 2020 dip, and then they saw a massive recovery. So that for a lot of people that are retail investors now, they've come into the stock market, this is the first time kind of witnessing stocks not working out, not going in their favour. So they're kind of getting adjusted to that, and that's why they're also emotional to it, because they're seeing a lot of their investments lose 20, 30, 40, 50%. Growth stocks, small market caps, you know, 60, 70%. They're getting adjusted to that as well. And the thing as well is, like, when we talk about small caps and growth stocks, a lot of these stocks are at crash prices. You know, a lot of these stocks have gone down to the lowest valuations they've ever been. So we're not only just going through a stock market or where the indexes have dropped 10%, quite a few people got stocks that, if are outside of that, that over the last few months have dropped like 50%, and you generally don't get them sort of drops in share prices unless you have a stock market crash. And that's why it's really affecting people, is because you're looking at the indexes, and the indexes are only down a couple, well, you know, 10, 15%, where outside of that, there's plenty of people now also got stocks that are down, you know, 50, 60, 70%. These are major crashes that are going on in a lot of stocks as well. So a lot of people are having to deal with that at the moment. And now that the large caps are actually dipping, obviously that's bringing it down even more. And I generally do think that large caps have maybe a bit further to go. On a little point of the small caps, I do look at the small caps now and thinking, a lot of these small caps have dropped that much. I don't know how much lower they can go. You know, there's so much negativity out there with the small caps and the growth stocks, that I look at the negativity that's out there, and I generally think they could be near the bottom now. That's where I'm at with a lot of them, but the large caps, I do think they've got a lot more to drop. But the big thing is that we've had a valuation correction. You know, without doubt, we did start to get to the point where valuations were very high, and now we've got to a point where the valuations are correcting. Now, the big thing you got to look at now is you got to look at what valuations are at, and without doubt, you look at some of the big tech, they're still kind of at pretty decent valuations, but you have a lot of growth stocks here, and you look at a lot of the growth stocks, and you're looking at some of them companies that are the lowest valuations that they've ever been, and now people are seeing some of the companies that were very happy to buy at 52-week highs, and they're seeing them companies now at the lowest valuations they've ever been, and now they don't want them companies, which is really weird to see. Now, just to kind of conclude all this and kind of get past this point of the negativity that is out there, these are the key things you want to think about here. So the first one is Motley Fool and My Wall Street. So if you're on the Patreon, you guys know we talk about these all the time. You know, these are two, Motley Fool's stock advisor, rule breakers, have really good track records, and also My Wall Street have very good track records as well. And they historically buy a lot of growth stocks, and normally they don't worry too much about valuations. And a lot of their growth stocks at the moment, a lot of their growth stocks are down, you know, 50+% at the moment. Does that mean that these guys that have history of beating the stock market have suddenly gone bad stock pickers overnight? No, what has happened is you've had growth stocks that have lost a huge amount of value, gone into crash scenario here, and have fallen off a cliff. But when you look at that from a stock market picker's point of view, you know, all you do is you look at them companies and go, okay, I'll buy you a bit more. And these are stock pickers that have really good track records. They're not suddenly going to, you know, pick bad growth stocks. It's just that they've all fallen off a cliff over the last couple of months. And over long term, if you believe in them growth stocks, if you looked into the story, if you have belief, they will pull in good returns. And you look at someone like the Motley Fool or My Wall Street that have history of picking really good growth stocks, what will probably happen? They will come back into value over the long term and do very well as long as they continue the growth up there. So that's just someone from a historic point of view that is really good at beating the market. Look at what stocks they've picked, look at the short performance, but what will they do in the long term? Like they've done previously, the stocks they picked previously, they'll probably go on a very good run. The next thing is to buy the dip. You know, you want to be, if you see good companies at decent valuations, you want to keep buying. What I'm seeing now is people trying to time the bottom. People are giving up on stocks. People are going, oh, now that it's dipping, I don't want to buy it. I'm going to wait. I'm going to try. I think they'll rebound and then I'll try buy in. You want to be buying good companies at cheap valuations. In the stock market, that's what you want to do. If you see something that's on sale, the more money you're going to make is by buying that at a cheaper valuation and bringing that average down, because when it rebounds, you're going to make more money. You know, there's a lot of people here that were buying companies at, you know, $50 and now it's down to $25, are hesitant to buy it. Well, if you've got the belief in the company, you should be scooping that up if you believe in it in the long term. So more than anything, if you're seeing something that you really like at the moment, you want to be buying the dip, especially what you have right now, which is a lot of companies at the lowest valuation they've ever been. You know, you're seeing a lot of growth stocks, and even if it's not growth stocks, if it's the big blue chips, if you're seeing big blue chips on 20-30% dips, it might not be the lowest valuation they've ever been at, but that's a pretty decent discount that you've got them stocks on. And if you're looking at a lot of the growth stocks, they've been hit even harder. You know, they're down 50+% on some of them, and they're at lowest valuations they've ever been, or they've had, you know, 2 years of gains wiped out on the share price. If you're looking at a lot of them stocks at lowest valuations, why have you stopped buying them? If they're at the lowest valuations they've ever been at, maybe you should carry on buying them, because at some point they will come back into favour, and you're getting an asset at cheaper valuations, you factor in the growth over the long term, you should do quite well from buying them stocks. And the last thing is having a game plan. You know, you're seeing so many people now that are getting caught out because they just bought a stock chart, they bought a stock symbol, and had no game plan when they're buying the company. If you've bought a company and you have like a 5-year game plan, you understand the company, you know where it's going, if you know where the profit's going to go or will start to go in the long term, if you see where the revenue is going to grow, even if you bought the company at not an amazing valuation, but it's losing valuation and you can buy that average down cheaper, if you have an understanding where that business is going to go in the next 5 years, what's going to more than likely happen is if they move in the right direction as a company with revenue and profit, you'll make more money on it. That asset will go up in value. You know, if a company is making 1 billion and in the next 5 years it ends up making 3 billion, it's probably going to be worth more. And even if it's a growth stock and it's losing money, as long as the losses start shrinking or it starts moving that path to profitability, you know, it's probably going to be worth more money at the end of the day. You know, like a stock like DraftKings was worth 3 billion a couple of years ago. Even now, after everything that is dipped, it's still worth 10 billion. So that's the big thing. They will move in the right direction. That's the main thing you've got to remember. So this is the big thing, is understand what you own, have a game plan, understand that as long as the company moves in the right direction, you'll be okay. And if you have an asset and it's at the lowest valuation that it's ever been at, why are you not buying that? You should be buying that for sure. So yeah, hopefully that covers a few points that I saw on the video on Friday anyway. So I hope you enjoyed it. If you could, hit the like button if you're new, subscribe, and I'll see you next video.